Good evening, everyone. Today is 27th of May, 2026, and the time now is 8:30 p.m. Malaysian time. We are going to talk about the June 2026 forecast on the upcoming energy and how it impacts the global trends. So the theme of this month is actually Month of Encountering. At this platform is called Astrology and Global Trends, where we apply Chinese astrology and trend research to forecast on economic, financial, geopolitical events to help you to make a better investment decision. Okay, so the tonight's talk agenda, as usual, we start with the introduction, followed by the disclaimer, a brief recap of last month's forecast, the influence of the five elements energy, that means using Chinese astrology to forecast on what will be going on in June based on the chart itself, and also the June 2026 geopolitical financial forecast by BC through his own research. And we will end with a summary and a Q&A. First of all, I would like to put in some disclaimer. The content here is purely based on our study in global trends related to five elements in Chinese astrology and global trends research for you to use as a guideline in your investment decision. And I would always advise everyone to exercise caution in investment, especially in such volatile situation. So you need to do a lot of research to understand what you are investing in. And we will not give any stock advice here. Additional support for our members will be through email address or in the members Telegram group. We also analyze different regional economics such as US, Europe, and China. Please note that there might be inherent differences in regional perspectives, and the observations are purely based on our current studies. So it does not reflect any absolute definitive judgment about any specific regions. So let me do a recap on the May month. I think most of you all have experienced the May month. Is it peaceful or is it very chaotic? Can you put in the chat to let me know that you think May is a good month or is a chaotic month? Anyone? Nobody? Y'all don't feel anything? Everything is okay? Let me check who I have not mute. Burnout. Okay. Yeah. Let me mute. Okay. So
I think for those people who monitor it on a frequent basis, yeah, it has become very you will become very distraught, okay, because of the wild swings. It is because the central banks, especially from Japan, and also the Trump administration, both are trying to control the market, in a sense that when the yen weakens, normally when the yen weakens, the bond yield will actually go up, because people will know that inflation will be going up much higher. So when that happens, the BOJ would step in and try to manage the inflation narrative. So they try to manipulate the yen lower, and they have burnt tens of billions of dollars by selling US treasuries to get the US dollar and sell them to support the yen. So when you see the bond yield going up, everyone is expecting the market to suffer the consequence. But then when the BOJ step in, the yen weakens a bit, then suddenly everyone is bullish. So it has become a very manipulated market, to put it simply. Whereas in the where the oil actually moves up, then the Trump administration would actually short the futures. That has always been their intention, short the oil futures to tell everyone that the US is controlling the oil price, so you need not fear so much about inflation. But even if they attempt to do so, the gasoline price in the US has gone up rather substantially. And this is because while you control the futures, you cannot control the price of the physical barrel arriving at the refinery. So especially the US, they can actually, the refineries need different type of oil for blending in order to refine into gasoline. So while you try to control the price of the, let's say, WTI, other types of oil that comes in will also be more expensive. And that's why gasoline price have moved up as well. So while they were shorting the futures, they were also emptying the strategic petroleum reserve, the SPR. So right now, a lot of oil has been siphoned off the US reserves. And that's how they try to maintain, okay, the price of oil to cap the price of oil. Similarly, a lot of countries are also burning through their own inventories. For those members who recently received my report, you will realize that there is a certain bottom when, not bottom, I would say, a certain level. No need to reach the bottom when the oil inventories would actually be insufficient to power the domestic economy. And that's when the price of oil would suddenly shoot up because suddenly everyone would want to have that barrel of oil because the inventories have, have fallen to critical levels. So this is something to look at. Back to you. If
Mm. Okay, yeah. So we have a few members that reflect here. Chin On says burnout. Mitra say fine with me. And then yeah, PC says that chaotic but outward bias. So I can understand why is this. So we have already looked at the May month. May month is a sneak month. So it's 癸巳 So it's actually driven dominantly by fire and fire element. And I have already forecasted that there will be, extreme heats we are facing, and sometimes there are also flash floods, geopolitical tensions does escalates, although it looks like, it's peaceful at the beginning of the month, but now recently this week, we have seen that the war has restarted, and it seems that, what happened in China, Trump's visit to China, does it really bring us, the results that we want? Okay. And then the economic markets, there are high volatility in supply chain and also in some of the um, stocks market, especially in Hong Kong, is trend down. And another thing is that there's also scandals going on. Okay, so we look at the weather here. So there's El Nino chances that skyrocket in US. This is what we have forecasted on the extreme climates. And then the Iran Middle East, this just came in only. That I think is today. That US renewed strikes on Iran. And some of the geopolitical situations that causes oil supply to plunge below, as just now PCS says, we know that oil is part of the supply chain as well. Okay, and then the global market, it seems that it's also very risky, as just now BC has stated, and then a technology breakthrough and in this area, but with controversy. So we can see that the frontier AI for drug design. That means potentially there will be a breakthrough in medical using AI as well. Okay, yeah. So next, we will go to the month of June 2026 energy. So this is going to be quite uh, I would say a quite challenging month because first of all, the year pillar is already a horse and the month pillar is also a horse, so it's a punishment. So a lot of people will act very irrationally. They will rush on everything, okay, especially those that have horse in the chart. This is how they will impact it, and moreover the fire is so strong. So we will know that from this, roughly, we can know or forecast the extreme heat waves globally, which has already started, higher risk of of droughts and wildfire with record-breaking summer temperatures, where some regions, I think in Europe, is experiencing now, and also increased pressure on energy grids. Okay, when we have high temperature is already uh, effect an echoing effect that this will everyone will on the air conditioner, and this will also increase the pressure on energy grids. So in yeah, and we also have water and fire clash in the chart itself because I the day pillar. So there will be floods, heat wave. We have already forecasted that also in the year 2026 book on astrology and global trends. So the violent storms and lightning events were likely to happen, and also there will due to intense of the young fire energy, there will be escalation of geopolitical tensions, military posturing still in maritime regions, okay, political polarizations, leadership struggles, and also public confrontations. And it's also forecasted that there will be very high chance that the metal price will not be stable. And the due to the there is also shit in the chart in this June's chart. So there will be, some earthquake risk condition in some areas. And then the fire economy related to AI, energy, technology, military will experience speculative growth. As just now, I think earlier on, PC already stated, there is a that everyone is chasing maybe for memory chips now. Okay, capital flow and innovation races, and also it will have an effect on the inflation. So in the financial market trends, there will be high volatility phase or with sudden reversal that is expected. So this is the month June energy. And let's look at the hexagram. The hexagram here is actually uh is heaven, and this is a winner. And the interesting thing, whenever I see this hexagram, is it's a bit funny. You can see actually the wind here represent women. Okay, uh, I think it represent elder women, and also this represent the men. Okay, and the top one. So it's like
You say, you say the bottom one is elder women,
ah
so the top one is it young men? Because
no,
that seems to be the
it's
trend in China right now.
oh no, that one is because of period
The
nine.
elderly are going for the younger men.
Yeah, I know. Yeah. There's a lot of this type of things going on because of the women rise, and it's a middle-aged women, especially the middle-aged women. Okay. So but this one, the elder one, this 甜瓜 means the older man, the oldest man. It represents the patriarch of the family. Okay. So is this 搞瓜 means it it represents men, older men after a younger woman. This is how we look at it. Okay. So we will have you can see the interesting thing that are all the yang line here, and there's only one yin line here. Okay, so it's hidden forces that is entering the system, temptation, and also instability in political scandals and cyber incidences, financial shock, and also there could be some destructive positive breakthroughs. It could also mean that there will be, something. This is a yin line, and there are all the yang lines. That means they are after the yin line. That means there are some commodities or something in the market that people are fighting for. Okay, it means that. So it also could mean seductive market rallies as well. So I have to be careful. Seductive means that something that you wanted to go in, but it might not be a good it might not be a good time to do so. Okay, so this is what I can tell you on this month's hexagram. Actually, is quite matched with the 八字 or of the month as well. The 八字 chart or the 4 pillar chart of the month as well. Okay, so I think this is all for me for this one. So let's go over to PC's trends research and see how it aligns to what the Chinese astrology has forecasted according to the 5 elements chart. If you find this video informative, please give it a thumbs up and consider subscribing to my channel for more valuable insights and updates. By subscribing, you will be the first to know when I post new content. So over to you, PC. I stop share now. Okay, let me stop share. Hold on for a while. Yeah. Okay.
So let's have a recap. What we predicted and what actually happened. So for me, a lot of the things which I study, I try to refer back to the fundamentals. But certain things may happen that may not follow the fundamental, especially in the current dynamics in the market. Whenever there is some challenges, the central bank or government will come in to manage the narrative to drive the stock market higher. But underlying it, when the fundamentals are very weak, it will only be a situation whereby, similar to kicking the can down the road. So anyway, for US, we expect industrial production to slow due to disruptions in the supply chain and inflation in raw material costs, but instead the industrial production gain. We expected US budget deficit to expand. However, it contracted due to massive receipts from personal income tax. So this could be related to the superb run of the S&P throughout 2025. People need to declare their capital gains, and therefore personal income tax was much higher, and therefore contracting the overall budget deficit from over $1 trillion to back down below $1 trillion. So we mentioned that oil producers with full vertical integration would benefit from rising oil price, but as I mentioned just now, even Japan has suggested they might have to short the crude oil, and US has been actively shorting the crude oil, and a lot of countries have been using their oil inventories to reduce the to help ease the supply constraint. But all this is just like kicking the can down the road. So overall, the major oil producers like Exxon and Chevron, their stock, the share price actually fluctuated between some slight gain and some slight loss. But overall, they are quite flat for the whole month with some slight upward bias, which means even the gain is very low percentages, 1 or 2%, depending on the fluctuation. So in Europe, we mentioned that the high inflation and surging energy costs would impact Europe's stock markets. However, most of the major indices were mixed in May, with some taking their cue from Wall Street. So overall, there's a severe mispricing of risk globally. So the DAX gained 1.4%, CAC fell 0.3%, FTSE rose 1%. So where China is concerned, We want that the Trump and Xi meeting may not happen at all, as there was
Change to new dates.
until days before the summit. So there were actually no news from China side. I think only the 2 or 3 days before the summit that China announced that, yeah, Trump is coming. So a lot of people were also speculating that because of the Iran war, Trump may be too busy and delay the visit, but overall he still made it. But the summit is actually a nothing burger. Okay, nothing major came out of it. So we expected silver imports to continue to rise in April, but saw a period of cooling off as China imported a massive 836 tons of silver in March. So the kind of um, China imports that were expected did not materialize. But where we got right, so we predicted that the US Q1 2026 GDP would be underwhelming, okay? And it grew 2% below the Atlanta Fed GDP now, known data at 2.1% at the time of our presentation. So we did this in the month of April. So retail sales ex gasoline rose 0.6% month on month in March, but in April rose 0.3% month on month, reflecting a slowdown from March to April. US CPI rose 3.8% year on year, up from 3.3% a month ago. Now, the increase in inflation affected consumer sentiment, which plummeted to 47.6, which is the lowest on record. So you mentioned that Trump's popularity will continue to fall ahead of the midterm election, and the data from the economists, as per update, you can see that it has fallen to around negative 21 points. Okay, so with 486 days into Donald Trump's term, the president net approval rating is negative 21, up slightly since the prior week, with 37% approved, 57% disapproved, and 5% not sure. And we want that the next crisis may be financial related, not necessarily due to the war in Iran, although it plays a contributing part. What drives the yields of major bonds is because of the accumulation of debt that has risen over the past 2 or 3 decades that has now become a great burden to the government to continue to get funding at low interest rate yield. And that's why you can see that major government bonds from Japan, Great Britain, Germany, France, all moving up higher. This is because of the insufficient uh, funding, okay, that would require a lot more borrowing. And because of that, the yield investors who own bonds are not interested, and investors are also demanding much higher yield in order to lend the money. And that is why the bond yield moves up. Of course, the war make a lot of investors very nervous because on top of knowing that the government will have funding difficulties due to their poor economic performance, and also because of rising inflation. With the war thrown in, the expectation of inflation was also much higher. So over here, the only bond that outperformed the rest is the China government bond. Okay, you can see that the yield is 1.75%. But if you look at others, they are actually much higher. So in some sense, the Chinese government bond has actually outperformed the major economies bond. So in Europe, we want that Europe could face rising energy costs, leading to another energy crisis. So if we look at the current energy costs, we are at a level here And during the period of May 2022, okay, that was the period when the war, the war in the in Ukraine has become more more violent, okay, and a lot of bombing here and there that push the energy cost much higher. So right now, comparing over the period, okay, the 5-year period from May 2022 to April 2026, okay, the last 5 years, you can see that there's already a gap. So with the Iran war now entering its third month, we are seeing that compared to the period that is approaching towards summer, okay, even in the summer period where there was actually a supply crisis of crude oil that pushed the energy costs in Europe much higher, it has not reached the same level as right now when we are entering the summer season, okay? So that means that very likelihood the energy costs in Europe in the summer season would actually rise much higher. Okay, that is comparing the period over here, which is the summer of 2022, and right now we are going to approach summer of 2026. So we also mentioned that the damage to the overall economy is evident, and the spring 2026 economic forecast shows slowdown in growth as energy shock drives up inflation. Okay. Meanwhile, inflation in Europe surged. Euro area CPI rose 3% year-on-year, up from 2.6% a month ago. UK, however, experienced a decline. As indicated on the earlier slide, rising bond yields in major European economies are impeding the government's ability to fund their expenditures. So we already mentioned this, I think not only last month, but a few months ago, as soon as the war started, we already mentioned that the government will face a lot of pressure in securing funding because investors would demand much higher yield, and this is now revealing itself. And we mentioned that the rising inflation and bond yields and the ongoing energy crisis would weigh on Germany's business sentiment. So the IFO Business Climate Index has dropped down to 86.2 from a month ago, has dropped down to 84.2 from 86.2 a month ago. So you can see that there is a sharp drop since the war in Iran. And it will likely become worse because recent news reported that Bosch as well as Volkswagen has actually laid off many personnel as well. So in China, so we mentioned that the retail sales could slow, and it did, growing at only 0.2% year-on-year in April, down from 1.7% a month ago. So it has been the last 2 months where we have predicted that China's retail sales would actually start to decline if we compare to previous trends. So the sluggish outlook of the global economy prompted more Chinese households to save. Savings increased 5.74 trillion in April as households prioritized paring down debt over savings, and household debt reduced by a record 786.9 renminbi in April. China 10-year bond continues to outperform peers as expected. China's EVs exports reached a historic 430,000 units in April, marking a massive surge of roughly 110% year-on-year. So over the past few months, we already have been highlighting that. But if you look at the performance of the Chinese automakers. Their share actually didn't move much, okay? That is because domestic market has been pretty slow, because if you look at it, the retail sales, only grow 0.2%. Back in the days like last year, it would have grown by 3 to 4%. But because of the last year, there were a lot of encouragement by the government, in terms of insurance, in terms of subsidy, okay, for people to change from ICE to an EV. So that was what drove the people to convert their ICE into NEVs, that caused the retail sales to charge up. But with domestic market softening, even though there is massive expansion of exports, but it's not enough to support the fall in the overall domestic market. And that is why a lot of the Chinese automakers suddenly saw their share plunge, actually, when they look at the report, because the bulk of the profitability lies from the domestic market. So although retail demand for gold eased in April, the PBOC added 8 tons of gold in its reserves that month. This purchase extended their consecutive buying streak to 18 months and brought their total official gold holdings to 2,322 tons. Real estate remains a challenge as the government prioritizes reducing inventories and improving the quality of homes over expensive real estate. So if we look at the US economic indicators, Q1 GDP rose 2% year on year, CPI rose 0.6 month on month. Year on year, it rose 3.8%, up from 3.3% in March. The spike in the CPI was driven by energy commodities. So core CPI rose 0.4% month on month. Year on year, it rose 2.8%, up from 2.6% in March. PPI rose 1.4% month on month. Year on year, it rose 6%, up from 4% in March. Core PPI rose 1% month on month. It rose 5.2%, up from 3.8% in March. So retail sales rose 0.5% month on month in April. Year on year, it rose 4.9%, up from 4% in March. Rise in retail sales was primarily driven by increase in the price of gasoline. So overall, my take, the biggest contributors to the increase in retail sales were gasoline stations and online retailers. In part, the increase has been driven by inflation. Gasoline prices were up 12.3% month on month in April. And it is also driving consumers to purchase online for better bargains. And on top of that, a lot of the retail sales were driven by household expanding their credit. Industrial production rose 0.7% month on month. Year on year, it grew 1.4%, up from 0.7% in March. Housing starts fell 2.8% month on month. Housing permits rose 5.8%. Existing home sales rose 0.2% month on month. It remained unchanged from March. Pending home sales rose 1.4% month on month. Year on year, it rose 3.4%, up from negative 1.1% in March. Preliminary PMI for manufacturing came in at 51.3, while PMI for services came in at 54. Now, this is the Conference Board of Leading Economic Index for the US, which rose slightly by 0.1% in April, following a 0.6% decline in March. Overall, the LEI fell by 0.7% over 6 months between October 2025 and April 2026, a less severe rate of decline than its 1% contraction over the previous 6 months from April to October 2025. So what we are seeing here is that it is below zero, okay? and it has been in this area for quite a long time, and that signifies that it is in a stagflationary period. So the US Bureau of Census Bureau and the US Bureau of Economic Analysis announced that the goods and services deficit was 60.3 billion in March, up from 2.5 billion from 57.8 billion in February. So what is happening is that if you look at the chart here, the trade deficit has been gradually reducing versus prior periods. And this is mainly because there is lesser import directly from China, but there is an increase of import from elsewhere, okay, probably for mostly from Vietnam and Mexico, which actually are proxies for Chinese goods to go in. And on top of that, the major export for the US that help brings the trade deficit down over the last few months has been the export of gold. Okay, if you, for members who have received a chart, there is a chart which shows that there is a spike in the import of gold in the first quarter. So that could be and in the trade report also for the month of February and January, it also shows that there were a lot of export of gold. Okay, and all these gold are exported to elsewhere, but when refined is purchased by China. So indirectly, it's a flow directly to China. So in terms of the budget deficit, US government saw total receipts at 837 billion and total outlays at 622 billion in April, resulting in a total budget surplus of 215 billion. Year to date, 7 months from October 2025 to April 2026, total budget deficit was 954 billion. In the month of March, it was slightly above a trillion. So government debt is now at 39.2 trillion. About 10 trillion of that will need to be refinanced in the next 12 months. And US debt is still on target to exceed 40 trillion this year. Obviously, we are still 5 months for the US fiscal year. And definitely, I think the government debt will reach 40 trillion because every 3 months, about 90 days to 100 days, the US would actually add 1 more trillion. But a lot of the debt would need to be refinanced by the second half of this year. So that means that the government debt would likely to increase. And on top of that, based on the current yield, okay, the 10-year yield right now is close to 4.5%. Versus last year when it was in the region of, let's say, slightly above 3% or below 3%. That means that financing the US debt has become more expensive, okay? Because the interest pay, when you refinance your debt, it will be refinanced at a much higher interest rate versus the previous treasury note, previous bond. So that means that every significant increase in percentage of the yield would only result in much higher interest payment. And as I mentioned, a lot of the surge in the retail sales have been driven by credit. And right now, the household credit report shows that a total of 18.8 trillion of household debt now sits on the overall credit for household. Okay, and just in Q1 2026, okay, total household debt increased by 18 billion. The increase in retail sales has been driven by consumer debt, and 29% of consumers rely on buy now, pay later to fund their purchases. So we can expect that consumer debt will continue to go up on a new record basis, but you can see that the growth has been slowing down. That means that essentially consumers are also facing difficulty in meeting their payment requirements. Okay, not only that, you can see later on, they are also defaulting at a much higher rate. Now, the US government, of course, through the US Treasury, would try to maintain the yields from rising higher, because as I mentioned, higher the yields means higher the borrowing costs. And in the month of May, thus far, the US Treasury has bought back 5.67 trillion of debt. So previously, buying back the debt has always been QE via the Fed. And right now, we have QE from the Fed, although the QE, okay, the US Treasury is also running QE. And when both parties are running QE, you can know that there is a desperate attempt, okay, to prevent the yield from escalating higher because of rising inflation. So here you can see that China, for example, has reduced their US Treasury holdings from 693.3 billion to 652.3 billion. Now, this is like 41 billion lesser. In fact, at its peak, China actually held about 1.3 trillion US dollars in US government bonds. Right now, it's down to 6.52 billion, which means that they have reduced their holdings by 50%. Now, that is because China right now is expanding trade globally, where trade is being done outside the US dollar-based system. A lot of it is done through the Evelyn, can you hear me?
Yeah, I can hear you.
Yeah, just like the line was cut off.
Just now you were cut off a bit. I do not know. I think now it's okay already.
Okay, so
Okay.
as I was saying, China has exited its position in US dollars, US government bonds from 1.3 trillion right now to 652 billion. Okay, now that is because a lot of the trade that China does with the other countries is now via via domestic currencies or through chips, okay, which is the international border payment, okay? So, and it's not under SWIFT, okay? So that is why China is de-dollarizing its international trade. Now, Japan saw the biggest sell at 47.7 billion. And that is because the Japanese government is selling US treasuries to secure the dollars to buy the yen, okay, which means selling dollar to buy yen to prevent the yen from moving past a very damaging 160 yen to the US dollar. That is a psychology level that once breached, it will immediately herald the yen to fall further down, okay, to maybe 170 or 180 yen per US dollar. So the Japanese government wants to defend the yen this way by selling its assets, but this is the wrong approach. or maybe this is the only approach that they can do, because Japan's government debt is 250% of its GDP. If they raise interest rate, the JGB bond yield would have to rise accordingly, and that would actually prevent the government from securing the funding to meet its obligations, okay, and also to fund the economy. So imagine if it goes up higher, the government will be insolvent. The other thing is that they can, if the yen keeps on, if they need to defend the yen by raising interest rate, then the yen carry trade would actually unwind. So because of the decades of 0% to negative interest rate have allowed a lot of financial institutions to borrow the yen on the cheap, okay, to fund their purchase of securities. So for example, if Japan is offering negative 0.1% yield, okay, then they use that negative interest rate to buy US Treasury that gives a few percent in terms of gain. Then that means that, you know, it's a sure win. And on top of that, if they do not want to defend, if they do not want to raise interest rate, another problem would also happen. A lot of Japanese financial institutions, because of the government has been undergoing QE for so long, a lot of them believe that the most secure way is to buy the Japanese government bond, okay? So because they have invested so much in Japanese government bond, the rise in the yield, okay, imagine from negative 1% right now to 2%, that is almost 20 times increase in the yield that will cause the asset that they hold right now become a very toxic asset. So there is no way out for Japan. Raise interest rate, government becomes insolvent. Do not, and higher the yield, financial institutions would be holding a lot of toxic assets. So meanwhile, the yen will just need to go up to force the government to make a decision. But they do not want to make that decision. That's why they are selling the Bank of Japan is selling their US Treasury bonds to defend the yen. So that means that they are burning their asset, okay, for a very insubstantial kind of move, because once they have sold the US Treasury to buy the yen, it has come down from 160 to 155, but right now it's back to 159, all within a little bit more than a month. So they have spent tens of billions of dollars. Actually, what I found out is about 63 billion to defend the yen for a period of a month. Can you imagine that every month they need to spend tens of billions to defend the yen to prevent it from reaching above 160? I think within a year, the BOJ would become, you know, they would have no more assets. So that is why we are now entering a period where there's a lot of financial stress in the market. It has not moved to the stock market yet. So on the consumer and household side, credit delinquencies are on the rise. American households are falling behind on the most expensive forms of debt, credit card debt. Balances that are 90 days delinquent are right now 13.1%, the highest level since 2011. Auto loans, serious delinquencies hit 5.6%, the highest level on record. So first it hit those that are smaller type of asset, okay, auto loan. If it move up higher, then that would be the household, that would be the mortgage. But right now the mortgage is still quite all right, okay. Student loan delinquencies are back above 10% after repayment protections expired. Mortgage stress remain low by comparison, which is why the headline household balance sheet still looks manageable. So I think the most worrying part is the credit card debt. The higher the delinquency, the more people would want to reduce their purchases. And that would hit the economy hard because the US, 2/3 of the economy relies on consumption. So they are right now, auto loans delinquency are actually the highest on record. And we are seeing certain trends in the household, in the mortgage as well, but we'll come to that afterwards. So meanwhile, private credit crisis continue to expand. In fact, we first touched on private credit crisis about a few months ago. The credit sector defaults reached a record of 9.2%, up from 3.6% in 2023. And Morgan Stanley is warning could surge as high as 8%, well above the 2.5% historical average. Now, why is private credit now bursting at the seams? Because private credit, not a view of the SEC, okay? It is a private affair. That's why it's not, it does not follow closely government regulations. So what happened is that institutions are chasing for higher yields. So here comes private credit saying that, well, we have the money, we will loan to you, but it will be 8 to 10% a year. So for corporations that require this private credit, rather than going to the failure, they would opt for private credit. But actually invest in the data centers. So what happened right now is that a lot of the data centers have either been delayed or suspended because there's no energy. The US grid has not improved to the level that it can offer consistent energy. So a number of projects are being stalled because you need to have enough energy to run the data centers. And on top of that, when those institutions that invested in this, in the private credit fund, they want to pull their money out, they tell them no way, because the data centers are not operating, there's no money in, so they don't allow people to redeem. And that is why, and according to a report published by Wall Street Journal on 18 May, Fitch recorded 10 private credit defaults in April. 6 were new unique defaulters and 4 were serial defaulters, which means they continue to default. When funds are available, then they pay off for the redemption, but then they continue to default as well. So there is a mispricing of risk in the US market. First, we have the record high credit default in private credit market and rising delinquencies. And secondly, home sellers are outnumbering home buyers by a factor of 1.4 to 1 buyers to 1 sellers. So out of 1.989 million buyers, 1.359, sorry, out of 1.989 sellers, there are right now 1.359 buyers. So there's a gap of 630,000, which is a new record. So there are more sellers in the market right now. And why are there more sellers? So it could mean two things. Sellers are cashing up their home equity because their profit from their property investment have gained so much. Then it's time that they call their quits because they are very worried about the rising bond yield, which will then force the Fed to hike interest rate. which will then reduce demand for homes, and therefore their home equity cannot be realized. So perhaps more sellers are out there right now trying to cash in on their investment, or it could also mean another thing. Because of the rising delinquency, they got no other options except to sell their property in order to pay off their debt. And another thing is that, lately there's been a lot of layoffs, especially with the AI thing. A lot of big corporations that have been laying off tens of thousands of people, and they can no longer afford their mortgage. And that's why they are right now they need to sell their homes in order to at least maintain their livelihood while they look for a new job. So foreclosures rose 18% year on year in April. So the stock market and consumer sentiment are directly opposite of each other. Here you can see consumer sentiment has plunged to new record high, and the S&P is at record high. So there is this huge gap, okay? And the thing is, if consumer sentiment is so low, it's going to affect consumer spending, okay? And that will affect the US GDP because 2/3 of it depends on consumption. And the wealth effect is not lifting those without the capital to invest. Right now, only those that have invested in the stock market are making the money. And these are mainly the top 10%, which means a huge percentage of the people are still deprived of some normalcy in their livelihood. So the Shiller PE ratio is encroaching towards the dot-com bubble territory due to the AI and data center hype. We are right now at this area. Okay, this was during the Great Depression. This was the dot-com bubble. So the S&P might go up another few hundred points when it will become just overstretched. Okay, so this is something to look at. And Buffett's favorite indicator, okay, market cap to GDP is right now 230.7%. Okay, so that's why Buffett is sitting on $400 billion, though he's ignoring all the hype in the AI and technology because he believes that a time would come when everything would be readjusted, and that's when he will invest massively. So what could happen to the US? June, inflation will continue to rise. Market is mispricing the energy crisis because for members, I've shown a chart saying that in June, we will reach critical level in terms of oil inventories. June is the month when many countries' oil inventories would run dry. As inflation rises, pressure will build on US Treasury yields, forcing them higher. If Fed hikes, then precious metals will likely fall, but prices will be supported by heavy buying from China, thereby providing a buffer. So if we follow the stagflation period during the 1970s, gold actually went up from 1971 to 1974. Then it dropped as much as 50% before moving back up to a new record high in 1980. So right now if we look at it, gold has run up during the first level of inflation from 2000 to 5,000. Now it's dropping back down by about 20%. So gold might fall a bit further if the Fed hike interest rate, but it will then resume its uptrend. So probably if the Fed hike aggressively, gold could fall maybe another 10 or 20%. We do not know. Okay, much depends on the buying support from everywhere. But one thing we know for sure is that right now, central banks across the world hold more gold than US Treasury bonds. Okay, so this trend is right now in reverse. Previously, they hold more US Treasuries versus gold. Right now, gold more than US Treasuries. So they could be moving back up to the same level of the 1970s, where 75% of the reserves are actually in gold. Right now, it's closer to 30%, which is in gold. So rising bond yields, record high private credit default, and rising delinquencies could put pressure on the US financial system in the medium term. So best to avoid financial institutions. Do not invest in insurance companies. Do not invest in banks, okay? Because there's a lot of, just now, a lot of the data that I show is all related, most of them are related to finance, okay? So US market could see a reversal in big winners as investors exit their position to buy SpaceX. Now, there is, because they have already made so much money and everyone is so hyped up about SpaceX, so probably they will actually sell those that they make money and then invest in SpaceX. So there could be a shift in attention to space-related stocks. The enthusiasm in the listing could keep the market buoyant for some time. But there are right now some warnings from people who have already seen the prospectus, the IPO prospectus from SpaceX. The company is actually losing a lot of money. But there is so much optimism right now because OpenAI, okay, and Anthropic will be making their own IPO this year as well. But recently, Microsoft has already cut the has already cut its investment in OpenAI, and the Anthropic people who have done a study and Anthropic realized that Anthropic spends $3 to generate $1 in terms of revenue. So that is why there's a lot of pessimism right now, okay? Because the revenue base is being challenged. So Trump will likely focus on
Yeah,
reducing. Yeah,
I also would like to say is that actually the free access that we are able to access as a consumer to OpenAI and also to Anthropic, these are all subsidized token. That's why it's $3 to $1, which is not surprising.
yeah. So, but something interesting is happening in China. Okay. There's one company that is right now farming tokens. So they are treating tokens as a commodity, and they are farming it to sell to users. So that's very interesting. Okay. Members who have the weekly report will know which company it is. Yeah. So for Trump, it may involve him taking huge gamble to boost his popularity, and this could lead to miscalculations. May involve a major military strike against Iran or Cuba. So Europe, Germany Q1 GDP rose 0.4% year on year. France Q1 GDP rose 1.1% year on year. UK Q1 rose 0.4% year on year. So Euro area CPI came in at 3% year on year, up from 2.6% in March. UK CPI came in at 2.8% year on year, up from down from 3.3% in March. So this is down. So Euro area unemployment rate is 5%. In April, it was in March, it was 4.4%. Yeah. Sorry, in April 2025, year-on-year basis, yeah. So you can see that in terms of unemployment rate, from April 2025 at 4.4%, right now it has reached 5%. That means unemployment rate over the 1 year has actually increased. So Europe is facing surging inflation, more layoffs, and stagnant growth. Because if you look at it, 0.1%, 0.4%, 1.1%, in fact, is very low growth. Okay, this is the epitome of economy in stagflation, because there are sometimes when the GDP actually goes into negative. Okay, so it's fluctuating within a tight negative bias to slightly positive bias. And that's why, it's pretty stagnant the way that is going. So I think we know for sure that Europe is right now in a stagflation. Euro area retail sales rose 1.2% year-on-year in March, down from 1.3% in February. UK retail sales remain unchanged in April, with March being revised to 1.4%. Overall, there's a slowdown in retail sales, and this will affect the GDP. You can see that there was a peak in January, but then right now it has fallen here. Likewise for the Euro area as well. So German manufacturing PMI came in at 49.9 in May versus 51.4, while services PMI came in at 47.8 versus 46.9. France manufacturing PMI came in at 48.9 versus 52.8, while services came in at 42.9 versus 46.5. Manufacturing PMI, UK manufacturing PMI came in at 53.7 in May, unchanged from April, while services PMI came in at 47.9 versus 52.7 a month ago. The energy crisis is biting forcefully. Inflation is resurging. Almost all the PMIs were down, with only UK showing some resilience. Germany's manufacturing saw more job losses. Bosch cut 22,000 jobs, Volkswagen 35,000 jobs, Porsche 6,000, BASF, MAN, ZF, Pesto, and Bio and Tech all are also axing their employees. 486,000 job loss in Q1 2026 alone. Industrial production down 15% from peak. Unemployment at 12-year high. So Germany is the largest industrial player in Europe, and right now Germany is the entire of Germany's industrial base is being eroded. So what could happen in June? Surging inflation brought about by oil crisis will impact consumption. Retail sales could weaken. Surging yields will impede government's funding and crimp economic activities. This could force the ECB to hike. Europe is also attempting to decouple from China, which will only add to its manufacturing costs. All this will impact Europe's industrial competitiveness. Expect more layoffs and shutdowns of key industries. Business confidence and economic activities in Germany will continue to deteriorate. Due to the overall slowdown and massive layoffs across key economies in Europe, the political climate will be toxic. Expect mass demonstrations as public grievances escalate. So China economic indicators, CPI rose 1.2% year-on-year, up from 1% in March. Core CPI at 1.3% year-on-year, up from 1.1% in March. PPI rose 2.8% year-on-year, up from negative 0.9% in March. So that's a huge swing here. And this goes to show that the inflation or the war is eating into the supply of key raw materials. Okay, because not only has the war impacted the supply of oil, but it has also impacted the supply of sulfur, the supply of helium, and other type of raw materials. Okay, and because of the disruption in the supply chain, the input of raw materials has become more expensive, and that's why the PPI rose 2.8% year-on-year in April. Retail sales rose 0.2% year-on-year, down from 1.7% in March. Industrial output rose 4.1% year-on-year, down from 5.7% in March. Fixed asset investment fell 1.6% year-on-year for the first 4 months of 2026, compared to 1.7% for the first 3 months. Unemployment rate was 5.2% in April, down from 5.4% in March. China trade data, China foreign trade in renminbi denominated terms grew 14.2% year-on-year to reach 4.38 trillion, or 637.4 billion in April. Export rose 9.8% to 2.48 trillion, while imports went up 20.6% to 1.9 trillion. resulting in a surplus of 0.58 trillion. So you can see that imports went up because of the rising cost of materials. In the first 4 months, total trade reached 16.23 trillion, up 14.9% year on year. Rolling 12-month trade surplus is now 1.17 trillion. Now, at the end of December, it was about 1.2 trillion. So right now, you can see that the rising material cost due to the war is also affecting China's trade surplus. From 1.2 trillion right now is 1.17 trillion. So China real estate home prices in China first-tier cities increased slightly in April month-on-month, while second and third-tier cities reported narrow or unchanged price declines. New home prices in the first four first-tier cities edged up 0.1% month-on-month in April. Second-tier cities saw a smaller decline of 0.1%, while prices in third-tier cities declined 0.3%, unchanged month-on-month. Similar trends were seen in resale housing market, and data show 21 of the 70 cities recorded month-on-month increases or unchanged prices in the new home market, 5 more than in March. The figure in resale market was 16, down from 1 from the previous month. Year-on-year sales prices across all city tiers generally declined. However, first-tier cities saw a narrowing price drops in new and resale home prices. Most of other major cities reported narrower or unchanged declines, although third-tier cities saw slightly faster declines in new home prices. So China real estate, will take a very long time to recover. And some of the analysts also suggested that since the bursting of the real estate bubble in 2021, most of the homeowners have seen their asset price, their home price has fallen by around 30 to close to 50%, depending on the location. And because of this fall in their home equity, on top of the rising inflation, Chinese households are saving more instead of spending. And that is one of the reasons why real estate remains in the doldrums and retail spending is also being impacted. So here's my rough take on China's economy. Generally, the indicators were weak. Retail sales slowed from 2.3% year-on-year during January to March period to 1.9% in the January to April period. Worthwhile to note that retail services rose 5.6% in the January to April period, up from 0.1 percentage point from January to March period. The main culprit that pulled down retail sales was auto sales, which declined 4.8% year-on-year during the period. This impact is significant as it is a big ticket item. Industrial production slowed from 6.1% year-on-year during the January to March period to 5.6% in the January to April period. The main reasons for the decline in industrial production were decline in domestic demand and supply chain disruptions caused by the Iran war. And many factories were impacted by the sudden jump in the price of raw materials. There are some reports that state that factories suddenly closed and leaving a lot of their workers on the vine because the owners have absconded. So China is unlikely to launch excessive stimulus to remedy the situation immediately. Rather, this could be the time to squeeze out unproductive players. Instead, China will strengthen the foundation towards achieving its high-tech manufacturing ambitions. That is why the stress on education through vocational training. It is also encouraging foreigners to invest in R&D in the country via significant tax exemptions, relaxed visa requirements, and expanded participation in national science missions. And that is precisely why several major petrochemical companies in Germany, some biotech companies have made their entry into China. Meanwhile, it is also doubling its efforts to encourage consumption in services sector China needs its services sector to grow to offer wider job opportunities for the next generation. In terms of industrial manufacturing, we all know that China right now is running their robotics and also dark manufacturing, okay, which means manufacturing with the lights out using robotics. And the only way that China can ensure sustainable job growth is through the service sector. So what could happen to China in June? So after a rapid stimulus in Q1 2026, the Chinese government is unlikely to expand its stimulus. Rather, it will focus on tweaking economic policies. China government bonds will continue to receive investors' interest and outperform its Western counterparts. The strength of the renminbi versus the US dollar is a testament to this. Retail sales of consumer goods will remain a challenge, and uplift in consumption of services will help to offset the slowdown in the goods sector. Inflation will remain elevated, and this will prevent PBOC from easing its monetary policy. And what happened is that the PBOC recently, the only thing that they can offer was a 1-year loan at 1% interest. They cannot offer for a much longer period. So you can see that their ability is being restricted, okay, for monetary easing. Global demand for EVs continue to benefit Chinese exporters, but the slowdown in domestic demand will affect overall performance. PBOC will likely increase its gold holdings, especially since it's now fallen around 20%. Trade tension with the US and EU seems inevitable. China will continue to seek self-sustainability across the technology sector. Foreign peers' dominance over tech will continue to erode. And now, right now, there's a lot of speculation on the memory chips, okay, DRAM and NAND, okay. So what is interesting is that in the coming months, two of China's largest memory chip manufacturer will be listed, and their price is like 50% of those from Micron, Hynix, Samsung, as well as SanDisk. So you can imagine if they come into the market and they, with the successful listing, they would have the funds to expand their production, and then they can throw the price cheaper. So that is why I think the sustainability of this rally will be tested, okay? It may take a period about 6 to 1 year, but ultimately the price of memory chips will actually fall. If you understand the way China's industrial policy works, is that once they have the mass market, they already have the mass market in China, okay? Then they dump it in the international market, because to them, their cost of manufacturing is cheap, not because it's slave labor or cheap labor, because right now China don't have much cheap labor anymore. Everything is in robotics, high capital investment, but because they have that investment into robotics, that will make the production cheap. And that's why even if they sell it cheap, they are still able to achieve profitability. And because of that, they also want to secure market share. So one of the ways to secure market share is to international buyers is to sell it cheaper than the next competitor. So that is why when these two companies, once they get listed, then they will be working towards expanding their global footprint. And that would force the current market leaders to reassess their positions. Now, if you can imagine, China in a decade can take down a lot of Japanese manufacturers like Honda, Nissan, Toyota. okay, and they can take down Europe manufacturers, Mercedes, BMW, Korean manufacturers, Kia and Hyundai. The chips will be no different, okay? So that is why, when it comes to these memory chips, don't expect it to scale up over the next few years, another few hundred percentage points of increase, because I think the situation will change in 6 to 12 months. So real estate market will remain in the doldrums. The green shoots will grow at a snail's pace. So geopolitics, war has restarted between US and Iran as the US attacked Bandar Abbas and several boats caught laying mines along the Strait of Hormuz. Iran has vowed stronger retaliation. There's also the Israel-Hezbollah confrontation to consider. Right now, they are actually quite at opposite sides of each other. Okay, every time Trump would come out and say that there's a deal, but then eventually there's no deal, because Trump recent post stated that he wants all the Middle East countries to acknowledge Israel via the Abraham Accord, and that will be mandatory. I don't think a lot of the Gulf states would agree. Okay, so that already by itself would derail the peace talk. And secondly, war is still ongoing between Israel and the Hezbollah. So a lot of tricky situations until everything is sealed. Okay, the rest is just speculation. So although there were talks that the ceasefire is ongoing, the deal is probably dead on arrival, as both sides refuse to compromise on the treatment of enriched uranium and compensation due to the war. Somalia has entered the fray by announcing closure of the Bab el-Mandeb Strait, which is over here. Together with the Strait of Hormuz, they account for up to 30% of global oil flow. Okay, so far many countries have been relying on their strategic oil reserves to soften the blow of rising oil price. Now this is the chart that I referred to, okay, the danger zone. The US has been shorting the oil futures to drive the narrative that the spike in the oil price is under control. However, the chart on the right shows that global oil inventories will reach a critical level soon, and the outcome would be a disaster for the global economy. Russia and Ukraine war escalated, with Russia now demanding that foreign diplomats leave Kiev. This signals that Russia will intensify its bombing of the capital. Russia's retaliation was the result of an attack on a hostel, resulting in a mass casualty event. Military conflict will remain the centerpiece in June. So, Evelyn, back to you.
Okay, can you hear me?
Yeah,
Okay, let me, can you stop, maybe you stop share,
okay.
yeah. Okay, let me check, is this the correct deck? Yeah, okay. So, before we go to the summary, I have an announcement to make. We will have a special event, for the Firehorse Midpoint, talk on this coming 9th of June 2026. Is a free talk. The time is 8:30 p.m. where we will talk about, what will the second half of the 2026 be, a checkpoint, okay? And the outlook from Chinese Astrology and Global Trend Research is at 8:30 p.m. So here you will discover, the first half of the year, the forecast scorecard, the Pingwu year energy at midpoint, what it is, and the key energy shift for the second half, the October initial point, and also the period 9 positioning with BC also will talk about, I think, the first half and also the second half of what to expect as well. Is that your topic? I'm busy.
Yeah, I'll be looking at the second half, okay. What are the things that could happen? And certain industrial sectors will be discussed as well.
Yeah, okay. So we will put the link in the chat box and also in the Telegram channel so that you guys can register for the talk. Okay, so I think yeah, so let's go through the summary. Here I think we already know that overall is a fast moving global events for the expected in month of June to be hit and climate extremes, geopolitical volatility, speculations of financial behavior with sudden disruptive encounters because of the 搞瓜. Then there will be rapid escalation rather than stability, unfortunately, and the events that initially appear small may quickly become a major global developments. So over to you, I'm busy to make
Yeah,
the summary.
yeah, there will be intermittent conflicts and skirmishes in the usual geopolitical hotspots. Global oil inventories are falling fast, which could alter the dynamics in supply, resulting in higher oil prices and inflation. Bond yields will remain elevated due to mispricing of risk. Fundamental point to a major slowdown, although the stock markets disagree. This is why risks are pushing towards the extreme. And this is when we need to be a bit nimble and take profit when opportunity prevails. Return to dividend yields and value versus speculation. So these are the things to keep in mind. As I mentioned at the start, I've already moved a substantial of my portfolio into dividend paying stocks, mostly Hong Kong listed because their dividend yields are much higher, ranging from about 7% to 11 or 12%. Yeah.
Okay, so I think that's it from us for tonight. Would like to know if there's any questions. Yeah, let me just put in the link here as well so that you guys can also register. Any questions?
So, Evelyn, maybe we put in for membership. What do you think?
Okay, so those that are interested to join us in the membership, you can also join us for the um this is the sign up forms for the membership as well. If you're interested, let me just go through. Okay, hold on for a while. Yeah.
So you can try us out for the remaining half of the year. Uh,
Uh-huh.
I think for those who have visited our YouTube or Rumble videos, you will realize that our accuracy is around 80% most of the times. And as a member, sometimes you will get something extra. You get a weekly report where I'll share more in the terms of the market summary. And sometimes certain companies that come into discussion, we will also share it with the members.
Yeah, that's right. Okay. So this is what usually you will get. Oh, hold on for a while. Let me just go through this with you. Let me share. Stop share. And then let me
Meanwhile,
share
if
again.
there's any question, you can actually put it on the chat box.
Yeah. Okay, so this is what you get our early access to the full recording, okay, of this talk here, a welcome gift, as well as a presentation slides, what we presented today, exclusive Telegram channel, and then you will get this book for free as well, okay, and yeah, and also special discounts on our course. So for the premium members, you can get the weekly report with some Chiman direction and also the daily Chiman direction with the weekly market insights as well. So these are, these are the memberships that we have. Okay, yeah. So let me just yeah. I think if you look at the chat box, there's one questions, right? PC.
Um,
Yeah,
okay,
from Stephen Phone.
will the market test the new Fed chairman in June? I think the Fed chairman um will more likely listen to Trump, okay, although that's his initial response, okay. But I believe that eventually, if inflation remains very high, he may have to hike interest rate. But he did mention something interesting. He said that the Fed previous model on inflation is wrong. So he may need to look at a, a revision of the Fed model. Now, it could also indicate that if let's say he shift the goalpost, so instead of monitoring inflation uh, uh, month on month, okay, or year on year, he might want to look at average inflation over the last 5 years, let's say. Now, of course, that inflation when average down, when it's average over 5 years will be down, and that could give him the premise to cut interest rate. But it is going to be a very risky affair because if he does so, inflation is going to be much higher. So still yet to see his full press conference of the Fed policy, but we will only know in the June FOMC. But as I mentioned just now, with the current inflation, if it continues within the current Fed policy, they may be forced to raise interest rate. Yeah. And like I say, if the Fed raise interest rate, then the market will not like it. So any other question? Hope that answers Steve Fu's question.
Yeah. Any other questions? If not, then I think we can call it a night. Thank you everyone for attending.
Yeah, thank you for attending, and for people who just joined our talk session, do consider our membership. There's a lot of things that we can offer.
Okay. Yeah. I think that's it for tonight. Thank you.